You've been told the stock market is a fair, open market where everyone has the same opportunity. That's a lie. Every single day, Wall Street firms use legal loopholes to take money directly from your trades. And the worst part? It's completely legal. In the next 10 minutes, I'm going to show you exactly how they do it and what you can do to protect yourself. Last year alone, Wall Street firms made over $12 billion from retail investors like you. Not from smart trades, not from better research, from structural advantages built into the system itself. $12 billion. That is money taken from ordinary people who thought they were trading on a level playing field.
Method 1. Payment for order flow. When you place a trade on Robinhood or any commission-free broker, your order doesn't go directly to the stock exchange. Instead, your broker sells your order to a market maker like Citadel Securities. Citadel pays your broker for the right to execute your trade. Why? Because they can see your order before it executes. They buy the stock a fraction of a second before you, then sell it to you at a slightly higher price. This happens billions of times per day. In 2020, Citadel alone made $4.2 billion from this practice.
Method 2. Dark pools. 40% of all stock trades in America happen off the public exchanges. These are private trading venues where institutional investors can buy and sell millions of shares without anyone seeing the price. That means the stock price you see on your screen is based on only 60% of actual trading volume. The other 40%? Hidden from you completely.
Method 3. High-frequency trading. These firms spend billions on technology that lets them execute trades in microseconds. That's 1/1,000,000th of a second. When you click buy, their algorithms have already analyzed your order, predicted the price movement, and positioned themselves to profit. A study from 2024 found that high-frequency traders extract over $5 billion per year from retail investors. You never see it on your statement, but it's there.
Here's what this actually costs you. The average retail investor loses between 1% and 3% per year to these hidden costs. That doesn't sound like much, but compound that over 30 years of investing. If you invest $500 per month at 7% returns, you'd have $567,000. But with a 1.5% hidden drag, you'd have only $412,000. That's $155,000 gone. Not to bad investments, to Wall Street's structural advantage. Wait, so even if I pick the right stocks, I'm still losing money to the system? Not losing, having it taken. There's a difference. When you lose money on a bad trade, that's your decision. When the system extracts money from every trade you make, that's by design. How is this legal? Because the people who write the rules are the same people who profit from them. Strategy 1. Always use limit orders, never market orders. A market order says buy at any price. That's an open invitation for market makers to give you the worst possible price. A limit order says buy only at this price or better. It removes their ability to manipulate the execution price. This single change can save you hundreds of dollars per year. Strategy 2. Choose a broker that routes directly to exchanges. Not all brokers sell your orders. Interactive Brokers and Fidelity both offer direct market access. Yes, you might pay a small commission, but paying $2 per trade to save $50 in hidden costs is the smartest money you will ever spend. Strategy 3. The most powerful defense of all. Buy index funds and hold them for decades. When you buy and hold, you only execute 2 trades, one to buy, one to sell years later. That gives Wall Street exactly 2 opportunities to take a cut. Compare that to an active trader making 200 trades per year, giving Wall Street 200 opportunities to extract value. Time is your greatest weapon against manipulation. Here's the truth most people miss. Wall Street's manipulation is real, but it is also manageable. The system takes a small percentage from every transaction, so the fewer transactions you make, the less they take. The wealthiest investors in history, Buffett, Dalio, Munger, they all understood this. They bought quality assets, held them for decades, and let compound interest do the heavy lifting. That's not just good investing. That is how you beat a rigged system. You now understand something that 90% of investors never learn. The market is not broken, but it is tilted. And now you know how to tilt it back. Follow Wealth Untapped for more insights like this. Which strategy are you implementing first? Drop it in the comments.